This is a weekly chart of the S&P, showing you the reverse head and shoulders that we had at the bottom in the 2002-2003 era being mimicked again right here in March of 2009. And this whole rally we've seen since then, if you put it in perspective of the big picture, is potentially telling us that we're starting a new secular bull market. And that debate needs to take place. Now, what technicians are using to forecast this return to a new secular bull market, meaning a bull market of long-term duration, is this area here where the 40-week simple moving average, this arrow, has crossed over the 80-week simple moving average right here in blue. The 40-week simple moving average is in purple. And we've seen it again right here, and we've seen it again right here, and we've seen it again last Friday right here. So let's keep an eye on this, and I would encourage you to put into your technical analysis study, if you want to follow how this trend develops, and I'll show you where I stand on this situation today. And that we are at the end of the old normal, and we're transitioning to the new normal. And major shifts in sentiment have long-term ramifications for virtually all asset classes: real estate, currencies, metals, and equities, and bond market. Now, this whole era that we're transitioning to today seems to be led by a trend toward frugal global demand destruction. In America, ladies and gentlemen, 70% of our GDP, we have the leading GDP in the world of about 14 trillion. 70% of our GDP is consumption. And the American consumer buys the finished goods that the world produces. Think about this for a moment. America, about 350 million strong in population, is about 5% of the world's population. But yet, through our high standard of living, we consume about 28% of what the world produces. And the world looks to us, the world producers and savers look to America to be the market, the final market for finished goods that the world produces. Now I want you to think about this for a moment. Where were you 20 years ago? What were you doing? Where did you live? What were your hopes, dreams, and aspirations 20 years ago? Think about where you were in December 1989. Think about where you were in your career. Think about what kind of home you lived in, what kind of income you had, what your goals and aspirations were for you and your family going forward. Now let's think about where General Motors was 20 years ago. Look where they are today. They've just gone through bankruptcy. They liquidated through their credit purge cycle $130 billion of debt, and they've had to transition and reinvent their new normal lifestyle. And the jury is still out whether a General Motors is going to be able to compete with the foreign automobile companies. But you and I have had to transition our life, haven't we, over the last 20 years? 20 years ago, I was an investment banker. Trust me. I became a principal in Online Trading Academy on about the founding of the company back in 1997, 1998 era. So I've been one of the builders of this business. And trust me, 20 years ago, I had no clue that the opportunity for me to sit in front of a webinar with FXStreet and talk to people all over the world, that capability was even going to exist 20 years ago. So all of us have had to transition to our new normal. And ladies and gentlemen, let's talk about what created this credit purge environment. You see, we've had many periods of long, and the two that I want to look at today to bring your attention to was the credit purge of the 1930s right here in America, and what we're looking at is total debt as a percent of GDP. And we are now in the new normal credit purge era, and we'll talk about it in just a moment. We're in the very early stages of this credit purge environment. And you can see, ladies and gentlemen, that this chart measures, and this chart's a very important calculation. It's measuring how much debt does it take in a highly developed capitalistic economy like America to produce a dollar's worth of GDP. So no matter how big our economy gets, no matter how diversified the basket of products and services, we produce or consume, how much debt does it take to fulfill that economic model? And this is what it's looked like since 1870. Now, notice from 1870 through 1920, debt as a percent of GDP was about 150% of GDP, right along this line. There was a credit binge in the 1920s, which turned out to be unsustainable in 1929, and we experienced the credit purge environment of the 1930s. And as a percent of GDP, this is the high water mark for credit purge as a percent of GDP. It's the biggest the world has ever seen. Now, you cannot have a credit purge era without a credit binge era that set it up. Now, after the credit purge of the 1930s, we go right in here and look at this. From roughly 1940 through roughly 1980, another 40 years of time, we had debt as a percent of GDP in America, and we had some remarkable growing economies during this period of time, but debt as a percent of GDP was only about 150% of GDP. And who was elected right here? 1982, Ronald Reagan. And we have another credit binge environment, and we've had a 20-plus year credit binge environment.